Hello and welcome. I am Martin Mankabardi. I am one of Denton's global practice leaders for insurance. And over the next 5 minutes, I'm going to be talking about the Insurance Act 2015, which has just come into force in the UK. And this represents the biggest change to insurance contract law for over a century. In fact, since 1906. And it applies to all business insurance which is subject to English, Scottish, Welsh, or Northern Irish law. And the background to this legislation is that it's an attempt to modernise and overhaul insurance contract law to make it more consistent with market and business practices, and as well as redressing the balance between an insured, a policyholder on the one hand, and an insurer on the other hand. Now, the Insurance Act 2015 is a one-size-fits-all legislation. It's a very short piece of legislation drafted in quite general terms, and it covers a wide range of businesses from FTSE 100 companies all the way down to small micro enterprises. So what are some of the key highlights in the Act? Well, the first thing the Act does is introduce this concept of a fair presentation of the risk. So this is a duty which the insured, which the policyholder has to discharge. So what the Act has done is kept the concept of the policyholder, of the insured, volunteering information to the insurer. But there is a requirement on the insured to disclose information in a way that is reasonably clear and accessible. So an insured cannot dump information on the insurer, on the underwriter. It cannot provide information which is overly cryptic or brief. And so I suspect that one of the consequences of the Act is that insurers will have to do more work together with their brokers, if they have a broker involved, in terms of filtering of information and giving thought to how they present that to the underwriter. The other thing is that insured policyholders, they are now fixed with constructive knowledge, which is information which would have been revealed by a reasonable search of information available to them. So that includes not only information that they have in their own possession, but also information which their agents may have, which could be relevant to the specific risk, particular risk that they want to lay off and underwrite. And this is going to require a change probably to systems and processes, and they're probably going to put together questionnaires or other ways of trying to flush out this relevant information. Now, one issue for underwriters to watch out for is that if something is disclosed to them by the insured, which puts them on notice that they need to make further inquiries, then they need to do so. And if they don't, it's probably the case that the insured will have still have discharged its duty of making a fair presentation. So the onus will be on the underwriter in that case to ask further questions. And in fact, it's anticipated that there will be more engagement between the insured on the one hand and the underwriter on the other hand. There's going to be a much more dynamic process going forward. From the underwriter's point of view, the underwriter is also fixed with certain knowledge requirements, with certain knowledge that it either has or is presumed to have or ought to have. And that knowledge is knowledge which the insured does not need to disclose to the insurer. I think one of the key issues around here is going to be around constructive knowledge, that knowledge which the underwriter ought to have and which the insured is not required to disclose to the underwriter. And that will include information which an employee in the underwriter's organization may have and which it ought reasonably to have passed on, whether or not it does, and also information generally readily available to that underwriter and which is held by that underwriter. So that could be a database, for example. And so what underwriters need to do is also make sure that they put in place the right systems and processes to make sure that they're flushing out all relevant information which an insured may not be required to disclose to them, but which could be relevant in terms of deciding whether to accept a risk and on what terms and how to price it. One of the other big changes introduced by the Insurance Act, and this is all part of the issue of trying to redress the balance between the insured on the one hand and the underwriter on the other, is a new proportionate remedy regime. Previously, underwriters could avoid a policy in a number of different circumstances, and the view was that this was quite a draconian remedy which underwriters had and was a bit like taking a sledgehammer to crack a nut in a number of instances. The new Act introduces a proportionate remedy regime. Now, underwriters still have a right to avoid a policy if there's been a deliberate or a reckless breach of that duty on the insured to make a fair presentation. So deliberate, so the insured knew what it was doing, or reckless, it didn't care as to whether or not it was making a fair presentation. Now, if an insurer can show that, the underwriter can avoid the policy. Where the underwriter cannot demonstrate deliberate or reckless breach, but there has nonetheless been a breach of that duty of fair presentation, then there are a number of options open to the underwriter. The underwriter can, if it can prove this on a balance of probabilities, that if some information which had not been disclosed to it and which it didn't know about, it wasn't information it was presumed to know about or ought to know about, and which was material, that it would not have written the policy, then the underwriter may be able to avoid the policy. The other option is that an underwriter could argue that if some information had been disclosed to it and which had not, it would have written the policy, but on different terms. It might have included an exclusion, for example. Or, and this can be in conjunction with that point I just made, the underwriter could argue that had it known this extra information, it would have still have written the policy, but charged more premium. Then, and if this goes to a court of law ultimately, the policy will be rewritten or the policy will be treated as having a higher premium. Now, the relevance of the higher premium point is that if a claim is due, and let's say for argument's sake, the extra premium would have been double, any claim payable is then reduced by half. So that is a significant change introduced by the Insurance Act. Another big area of change is around warranties. So previously, before the new Act came into force, if there was a breach of warranty, that would be an automatic discharge of the underwriter's liability. Going forward, a breach of warranty only suspends the underwriter's coverage, and if that warranty is capable of being remedied, and it is remedied, then that coverage comes back into play. Now, where you've got a breach of a warranty and it's not relevant to a loss, then the underwriter can't exclude or restrict liability. The only caveat to all of that is that if you've got a term, such as a warranty, which defines the risk as a whole, whatever that might mean, and there's some uncertainty about that, then it is open potentially to the underwriter to exclude or restrict its liability. So what we're going to see is a lot more arguments around causation in this area, about whether a breach of warranty that hasn't been remedied, whether that caused a loss or was related to a loss. You're going to see many more arguments around that, which we did not previously. Final word, it is possible to contract out of the Insurance Act, provided that certain so-called transparency requirements are complied with, essentially requiring the contracting out to be brought to the attention of the insured, to the attention of its broker if it's got one. It'd be interesting to see to what extent the market does contract out of certain provisions. You may see it in certain lines of business, but on the whole, it may well be that most insurers are going to take the view that They're going to comply with the Act insofar as they can, unless there are good reasons not to do so. At least that provides certainty as to their position, insureds know where they stand. And after all, the Act was the subject of many years of consultation and hopefully does represent a more balanced approach to the various rights of insureds and insurers. So I think this Act will drive changes in the market. Some have said, isn't this all going to be a bit of another millennium bug where people think it's going to lead to lots of changes and in fact nothing happens? I don't think that's the case. I think this will drive changes in processes. I think you'll see changes in policy wordings and practices generally. But time will tell on that, and we may not see this over the next few weeks, next few months, but over time we may well see the changes that this new Act is going to bring into force. So thank you very much for listening to me. Appreciate your time.